Silicon Valley Bank was founded in 1983 by Wells Fargo executive Bill Biggerstaff and Stanford University professor Robert Medeiros, with a singular focus on financing technology startups in California's innovation corridor. Over 4 decades, the institution became the 16th largest bank in the United States and the preferred financial partner for nearly half of all venture capital-backed healthcare and technology companies. By December 2022, Silicon Valley Bank held $209 billion in total assets and $189 billion in deposits, positioning it as the lifeblood of the technology sector. But beneath this facade of specialized expertise lay a series of strategic decisions and regulatory gaps that would culminate in the second-largest bank failure in United States history. The seeds of Silicon Valley Bank's collapse were planted during the unprecedented liquidity surge that began in 2020. Between 2020 and 2021, venture capital funding reached historic levels, with technology companies raising $330 billion in 2021 alone. Silicon Valley Bank's deposit base exploded from $62 billion to $124 billion in just 12 months. The bank's total assets grew 271% from year-end 2018 to year-end 2021, compared to 29% for the banking industry overall. This extraordinary influx presented management with a fundamental challenge: where to invest these massive deposit inflows in an environment where interest rates had been driven to near zero by the Federal Reserve's response to the pandemic. Silicon Valley Bank dramatically increased its holdings of long-term securities, investing deposits in government-backed bonds and agency-issued mortgage-backed securities with extended maturities. The bank's total investment in securities increased from $23 billion in 2018 to $125 billion in 2021. By year-end 2021, the bank held $111.7 billion in fixed-income investment securities. Critically, management classified a substantial portion of these securities as held to maturity, accounting for them at book value rather than marking them to market. The average maturity of the held-to-maturity bond portfolio reached 6.2 years by the end of 2022, with 56% of the bank's assets invested in fixed-rate securities compared to less than 30% for large money center banks. This concentration in long-dated securities created enormous interest rate risk. The regulatory environment that allowed Silicon Valley Bank to grow without adequate safeguards was shaped by legislative changes implemented in 2018. The Economic Growth, Regulatory Relief and Consumer Protection Act raised the threshold for enhanced prudential standards from $50 billion in assets to $250 billion, exempting regional banks like Silicon Valley Bank from the most stringent oversight requirements established after the 2008 financial crisis. Silicon Valley Bank's chief executive officer, Greg Becker, who became CEO in April 2011, had actively lobbied for these regulatory changes. The bank was no longer subject to company-run stress tests and was only required to undergo supervisory stress testing on a biennial basis. Because the bank grew rapidly, it avoided stress testing entirely in 2022, despite holding massive unrealized losses. The bank was also exempted from enhanced liquidity requirements. Additionally, Silicon Valley Bank opted out of including accumulated other comprehensive income in its regulatory capital, a choice that allowed the bank to exclude unrealized losses on available-for-sale securities from its capital calculations. The economic environment began shifting dramatically in 2022 as inflation surged and the Federal Reserve embarked on an aggressive interest rate hiking campaign. The federal funds rate increased from 0.25% in early 2022 to 1.75% by the second quarter. This rapid tightening had 2 devastating effects. First, the market value of the bank's long-term securities portfolio plummeted as bond prices moved inversely to rising interest rates. By year-end 2022, Silicon Valley Bank had mark-to-market unrealized losses exceeding $15 billion on securities held to maturity, surpassing the bank's $11.8 billion in tangible common equity. Second, the technology sector entered a severe downturn as higher borrowing costs caused venture capital activity to contract sharply. Silicon Valley Bank's venture capital-backed clients began withdrawing deposits to meet payroll and operational expenses. As of year-end 2022, approximately 94% of the bank's total deposits were uninsured, meaning they exceeded the Federal Deposit Insurance Corporation's $250,000 insurance limit per account. The bank's depositors were predominantly technology startups and venture capital firms connected through dense professional networks and social media channels. Federal Reserve supervisors had identified problems at Silicon Valley Bank as early as 2020. In November 2022, supervisors issued a formal supervisory finding related to interest rate risk and planned to downgrade the firm's rating. Throughout this period, Silicon Valley Bank management failed to take decisive corrective action. Critically, the bank's chief risk officer position was vacant from April 2022 through January 2023. During this crucial 9-month period, as interest rates surged and unrealized losses mounted, the bank operated without a permanent chief risk officer. Management also removed interest rate hedges in 2022 that had been in place to protect against rising rates. By early March 2023, Silicon Valley Bank faced a convergence of pressures. On March 8, 2023, the bank announced it had sold approximately $21 billion in long-dated government securities, realizing an accounting loss of $1.8 billion. The bank simultaneously announced plans to raise $2.25 billion in capital. The announcement was intended to shore up the bank's financial position, but it had the opposite effect. Markets interpreted the capital raise as a signal of desperation. That same day, Moody's Investors Service downgraded Silicon Valley Bank's credit rating. The stock price fell 60% by the end of trading on March 9th. More ominously, prominent venture capital firms, including Union Square Ventures, sent emails to their portfolio of startup companies advising them to withdraw deposits from Silicon Valley Bank. The highly interconnected nature of the technology investing community, amplified by social media, transformed individual concern into collective panic.
Thursday, March 9th, 2023, began as a day of crisis management at Silicon Valley Bank, but ended as the largest bank run in United States history. As trading opened, depositors who had seen the previous day's announcements began initiating withdrawals. Silicon Valley Bank CEO Greg Becker attempted to contain the panic through a video conference call, urging clients to stay calm. The message failed to reassure. By the end of Thursday, customers had attempted to withdraw $42 billion in deposits, far exceeding any historical precedent. The 2008 collapse of Washington Mutual involved approximately $19 billion in outflows over 16 days. Silicon Valley Bank experienced more than double that amount in a single day. The bank could not generate sufficient cash to meet these redemption requests. Its assets were locked in long-term securities that could only be sold at massive losses. By the close of business on March 9th, Silicon Valley Bank had a negative cash balance of $958 million. Before markets opened on Friday morning, March 10th, 2023, California banking regulators acted decisively. The California Department of Financial Protection and Innovation closed Silicon Valley Bank and appointed the Federal Deposit Insurance Corporation as receiver, citing inadequate liquidity and insolvency. This marked the second-largest bank failure in United States history by assets. The speed of the failure was unprecedented. A functioning institution had gone from announcing a capital raise to complete insolvency in just 48 hours. The systemic implications became immediately apparent. On Sunday, March 12, 2023, New York state regulators shut down Signature Bank, a $110 billion institution that had experienced its own severe deposit run as panic spread through the banking system. The failures triggered fears of broader contagion, with depositors at other regional banks questioning whether their institutions might face similar crises. On Sunday evening, March 12th, Treasury Secretary Janet Yellen, Federal Reserve Chairman Jerome Powell, and Federal Deposit Insurance Corporation Chairman Martin Gruenberg issued a joint statement announcing an extraordinary intervention.
all depositors at Silicon Valley Bank and Signature Bank would have access to all of their money starting Monday, March 13th, with no losses to taxpayers. The statement invoked the systemic risk exception, a rarely used provision that allows regulators to protect uninsured deposits when a bank's failure poses risks to the broader financial system. Federal Deposit Insurance Corporation Chairman Martin Gruenberg estimated that Silicon Valley Bank's failure would cost the Deposit Insurance Fund approximately $20 billion. The Federal Deposit Insurance Corporation established a special assessment on banks to cover these costs, meaning the banking industry would bear the financial burden. The government's intervention protected depositors, but not shareholders or unsecured creditors. The Federal Reserve simultaneously announced the creation of the Bank Term Funding Program, an emergency lending facility designed to provide liquidity to other banks facing similar pressures. Under this program, banks could borrow funds using distressed securities as collateral, valued at par rather than their diminished market value. On March 13th, the Federal Deposit Insurance Corporation transferred all assets and deposits to Silicon Valley Bridge Bank, a temporary institution operated while a permanent solution was arranged. An initial auction attracted only a single bid, which the Federal Deposit Insurance Corporation rejected. On March 26th, the Federal Deposit Insurance Corporation announced that First Citizens Bank shares would acquire substantially all assets and deposits. The transaction included the purchase of approximately $72 billion in assets at a discount of $16.5 billion and the assumption of about $119 billion in deposits. The 17 former branches reopened as Silicon Valley Bank, a division of First Citizens Bank, on March 27, 2023. The government response prevented immediate systemic contagion, but the crisis continued. First Republic Bank, despite receiving a $30 billion emergency infusion from 11 major banks on March 16th, experienced outflows exceeding $100 billion in deposits during the first quarter of 2023. On April 28th, regulators seized First Republic Bank and sold substantially all operations to J.P. Morgan Chase, marking the third major bank failure in less than 2 months. Internationally, Credit Suisse faced a crisis of confidence as the Silicon Valley Bank collapse spooked global markets. On March 19th, Swiss authorities orchestrated an emergency merger with UBS for approximately 3 billion Swiss francs, eliminating one of Europe's historically significant financial institutions. On April 28, 2023, the Federal Reserve released a comprehensive review of its supervision of Silicon Valley Bank, acknowledging significant failures and oversight. Vice Chair for Supervision Michael Barr stated that the collapse resulted from management failures, an overly concentrated business model, and inadequate supervision. The report criticized the tailoring approach implemented after the 2018 regulatory changes, stating that it reduced regulatory standards and promoted a less assertive supervisory stance. Federal Reserve investigators determined that Silicon Valley Bank's board failed to oversee risks effectively, that management removed interest rate hedges despite rising rates, and that the bank repeatedly failed internal liquidity stress tests without developing adequate contingency plans. In May 2023, congressional hearings brought former executives before the Senate Banking Committee and House Financial Services Committee. Greg Becker testified that he never envisioned the bank being in such a situation and that management had attempted to address supervisory findings. He faced intense criticism, particularly regarding his earlier lobbying efforts to weaken regulatory requirements and his stock sale of $3.6 million worth of shares on February 27, 2023, 11 days before the collapse. In January 2025, the United States Senate's Permanent Subcommittee on Investigations released a comprehensive 292-page report examining the bank failures of 2023, identifying inadequate practices by KPMG, which served as auditor for Silicon Valley Bank, Signature Bank, and First Republic Bank. The collapse fundamentally reshaped discussions about bank regulation, deposit insurance, and systemic risk. Policymakers debated whether to restore enhanced prudential standards for banks with assets between $100 and $250 billion. The Federal Deposit Insurance Corporation undertook a comprehensive review of the deposit insurance system, examining whether the $250,000 coverage limit remained appropriate in an era where businesses routinely held millions in operating accounts and where social media could trigger bank runs within hours. For the technology community, the failure was a severe shock. Thousands of startups faced uncertainty about accessing funds. Many companies subsequently diversified their banking relationships, spreading deposits across multiple institutions. The broader banking industry absorbed difficult lessons about interest rate risk and deposit stability. Silicon Valley Bank's failure demonstrated that even a well-capitalized bank by regulatory metrics could become insolvent within 48 hours. The estimated $20 billion cost borne by the banking industry through special assessments represented a significant expense distributed across the financial system. The resolution preserved economic activity and prevented the failure of thousands of technology companies. Silicon Valley Bank, which had spent 40 years building relationships with the innovation economy, vanished in 48 hours. A cautionary case study in the consequences of misjudging interest rate risk, maintaining inadequate liquidity buffers, and failing to recognize how fragile institutional trust had become in an interconnected digital age.